Well, it is Jackson Hole 2023, which begins in about 14 minutes. But boy, oh boy, you are going to want to know what Jay Powell said last year. And I've already broken it down for you. And boy, oh boy, it is not a surprise why markets freaked out in hindsight. Look at what was said in 2022. Jerome Powell, who usually gives a 20 to 30-minute speech at Jackson Hole, took 8 minutes last year to set the record straight. The Fed was going to, quote, force demand down, force supply and demand into balance. He warned about prematurely loosening policy, and he said we would likely face a period of sustained below trend growth, which would be below 2% GDP. He talked about all of this while inflation was at 8.2%. That's something that's critical to remember here is Jerome Powell's last Jackson Hole meeting was August of 2022 when inflation was actually sitting at 8.2%. Today, inflation sits at 3.3%, and it's been falling for 12 months, with only this last month showing a tiny little tick up because of energy. That's our non-core figure. The labor market, he said last year, was clearly strong. That has changed. Supply chain constraints have changed. Yet we're also growing at above trend growth, which does make some folks wonder, well, if the Atlanta Fed thinks our GDP currently sits at 5.9%, then are we about to be in a world of hurt? Well, it depends. Inflation expectations remain extremely well anchored. Not only is that the case, but last year at Jackson Hole, Jerome Powell had his lower bound at just 2.25%, and he was threatening 75 basis point hikes. Think about how far we've come. It's so easy to forget about the days of 75 BP hikes, and here we are talking about maybe basically 12 and a half basis point hikes. That's because when you skip a meeting, you divide 25 by 2, right? Anyway, we actually were not restrictive with interest rate policy at last year's Jackson Hole. This year, we've been restrictive all year long. Well, for at least 6 months. Jerome Powell talked about how Bernanke told us that the 70s was a period of time of understanding the Federal Reserve's role in inflation, that the Fed works on demand, and that it's their job for the better of society, people, and the economy to control inflation. Well, today, Jerome Powell could potentially declare a victory on at least trending towards 2% inflation. It's unlikely, though, that he's actually going to declare any victory. So we want to eliminate that bull thesis, because if Jerome Powell came in today and said, well, we can cut because we won, inflation would probably unanchor relatively rapidly. This would not be what Jerome Powell wants. So that is unlikely, and it didn't even make it to my bingo card. So let's talk about the bingo card. This is the bingo card. Oh, that's not the bingo card. Hold on, let me get up the bingo card. This is the bingo card. Hold on, give me 1 second here. Let's fix this. By the way, I'm also now streaming on TikTok, but I have a little bit of problem when I do it there. I will fix that quickly. And that is now fixed. Okay, there we go. This is my Fed bingo card. What I encourage you to do is screenshot this and then put it into like some kind of PDF annotator or whatever, and think to yourself, hey, how many of these items did we end up hitting? So personally, I'm pretty excited about this bingo card. I always talk about having a bingo card, but it's the first time I'm like actually doing the bingo card. So we've made a bingo card. And the bingo card has multiple different items on it. I think they're all exceptionally valuable. So first, I have 12 months of inflation declines. Check. Let's see if he says it. If he says it, what we'll do this time is we'll actually check off the items as if we're playing bingo. And we'll see if we get bingo here, okay? Although I know it's not a 5x5. It's a 4x4 bingo card, okay? I spent a whole total of like 3 minutes making this, okay? So Appreciate some support about the creativity here. No, anyway, so 12 months of inflation declines. Recession not being a base case. We'll check that off, obviously, if he mentions that. Higher only if inflation goes higher. This is interest rates, right? So interest rates should only go higher if inflationary data comes in higher. Restrictive for 6+ months. I think this would be valuable to hear. That way markets can digest. Yeah, I mean, we have kind of been restrictive for a while. It's too early to call a peak, but may be there. In other words, we may have arrived at a peak, but it's too early to say with certainty. We expect him to say banking is sound and resilient. This is it's kind of like a freebie, okay? This is like the bingo in the middle of the bingo card. Paul Volcker controlled inflation. We did / will as well. So some kind of invocation of Paul Volcker and the respectable efforts he made of restoring Fed's credibility. So that would sort of be in the credibility world here. Flexible average inflation targeting. That's going to be a stretch to expect J. Powell to start talking about fate, but it's going to happen one of these days. Positive real rates. This is a way of saying that when we take what rates are and we subtract the rate of inflation, it's positive. So, for example, you say rates are 5.25, inflation is 3.25, you're at +2, just as an example, right? You could do the same math with the 10-year Treasury yield or the 2-year Treasury yield, both of which are positive. The 10-year being positive by closer to 1%. So just as an example, you would just take whatever the 10-year yield is, which currently sits at 4.23, and subtract that from the current approximate inflation rate. Just a heads up, by the way, I am short Treasury yields in that I'm long ticker symbol TMF. So bias exposed. I have a leveraged bet on on yields falling here. So I'll do my best to be as neutral as possible. That's always my goal, whether it's politics or Tesla or whatever. If there's bad news, I'm going to give it. If there's good news, I'm going to give it. But I'm not only just going to cuck to one side. I hate that. Although social media prefers that, it seems. But I can't live like that. Anyway, anchored inflation expectations will be another. Greenspan, or invoking opportunistic disinflation. I prefer this over Paul Volcker. This would be really cool if we got some kind of invocation of Greenspan. This would be the 20 years of basically allowing inflation to trend down. So we'll see what happens there. Warning against a premature loosening. I kind of hope we don't get that. Like, ideally, we don't get that. So if this is going to be a bullish business card, let's go ahead and flip that, okay? So let's say don't warn against loosening prematurely. I'm changing that to don't. So because I want to like check all these things off the box, okay? If we could check all these things off the box, we win. So yeah, let's go with don't warn about loosening prematurely. Then which he did last year. Then we want him to mention that, hey, demand being above trend could actually be okay. That would be fantastic, okay? We want to hear something about jobs being in balance, not this excess demand again. Supply being in balance, not this excess supply chain constraint issue. And then unemployment at 4% maybe being acceptable, but not much more. We don't want to see the unemployment rate skyrocket. So that is going to be our Federal Reserve bingo. And I'm very excited about Federal Reserve bingo. So we're just going to quickly do an audio test here. So if you can give me a heads up that CNBC functions.
Yeah, I'm expecting a very balanced message. Markets went into this thinking there's about a 50-50 shot of one more rate hike before the end of the year. And I don't think he wants to change expectations, because what I think he wants to do is leave the options open when they meet in September. So, I think he can take a little bit of a victory lap, because the truth is We've seen lower inflation and stronger growth than he expected a year ago.
There is no way he's going to take a blunt victory lap, but he may take an implied victory lap.
Really meeting their goals.
And that's what I'm wondering is what's the bigger risk? Staying steady, hiking when we don't need it yet?
Oh, definitely the bigger risk is hiking again, because we don't know how long these lags play out
Sure.
for. What we do know is there's every reason to believe inflation is coming down some more. The global economy is softening. Those were pretty lousy PMI numbers we got this week for the global economy. But also, new car prices haven't moved at all since the start of the year. In fact, they're falling. Rents haven't moved since the start of the year, and we know how that feeds through to inflation. So we're going to be...
Thank you very much, by the way, for the heads up here that everything functions in terms of CNBC. We will not solely be relying on them for the meeting. I'll have the meeting up separately as well, just in case there's any kind of issue with CNBC, although I don't think there will be. I will add commentary when necessary, and obviously we're going to be playing the bingo card together. Of course, I do, when I present videos, try to keep my commentary during to a minimum so we can hear every word that the person talking says. I think that's important and respectful. So, but anyway, yeah, we'll add commentary just as necessary. So, yeah, all right. We are now 3 minutes away.
Going to recession. We've got that many people trying to hire, and that's keeping the unemployment rate low, even as inflation comes down. So this is a very bad time to try to figure out the long-term behavior of the economy. We're still in a very weird position here.
Just got you, Mish. We'll talk about those numbers in a moment, but let's get to our Steve Leisman and Jackson Hole, moments ahead of the Fed chair. Hey, Steve.
Yeah, a Fed chair is starting right now. He is going to be, I would say, mostly hawkish, saying that the Fed...
He's starting in 2 minutes. Okay, he thinks he's going to be mostly hawkish. Okay, University of Michigan. Oh, there he is.
Until we're confident that inflation is moving down. He says it's the Fed's job to bring down inflation. Quote, "We will do so." Although he says inflation has moved down, it remains too high. He says we are in a position to proceed carefully and assess incoming data as it's evolving. Finally, he expresses some doubt about the recent decline in inflation, says even with more favorable inflation numbers, the process is still has a long
and intend to hold policy at a restrictive level
only the beginning,
until we are confident that inflation is moving sustainably down toward our objective. Today, I will review our progress so far and discuss the outlook and the uncertainties we face as we pursue our dual mandate goals. I will conclude with a summary of what this means for policy. Given how far we have come, at upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. The ongoing episode of high inflation initially emerged from a collision between very strong demand and pandemic-constrained supply. By the time the FOMC raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. While these two forces are now working together to bring down inflation, the process still has a long way to go, even with the more favorable recent readings. On a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022 and declined to 3.3% as of July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since early 2022. Headline inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome, but 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. we can't yet know the extent to which these lower readings will continue, or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the three broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown, and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well. And we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's symposium, the 2-year real yield is up about 250 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer run trend. And recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year, but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54, and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high, but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response.
Could.
Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
Take a look at bingo. This is the bingo card so far. So let's go ahead and review this. Bingo card we got the 12 months of inflation declines. We got the higher only if inflation goes higher. This was a lot of the could talk that we got from Jay Powell. We got the restrictive for 6 months. We got expectations are anchored. We got positive real rates. We got jobs getting into balance, but I had that written as imbalance. Supply is getting into balance. We did not hear anything about banking. No Greenspan, no Volcker. Didn't warn about loosening prematurely. Oh, we got that. That's great. That's actually great. Let me double check that because we have the transcript here. And I just want to see the word premature really quickly because maybe did he mention that? Because if he didn't mention that, he didn't mention that. Oh, that's really good. Mature. No, the word prematurely was not used. That's a big deal. I actually like that a lot. Okay, good. So let's add that to the bingo card that he didn't mention. Warning against prematurely loosening. He did not invoke Paul Volcker, didn't invoke Greenspan, didn't invoke fate, didn't tell us about unemployment potentially being, what level would be unacceptable to them. We didn't get that. So there's some things we didn't really get here. This, I would probably give us this too early to call peak, but maybe they're very dependent on the data here. So this is kind of my bingo card. You can compare it to what you did, but let me give sort of an overall view here. I would say this was a very neutral Powell. He didn't really, he certainly didn't pummel us like last year, right? Last year was a complete pummeling because he's like, we're not even restrictive yet. We got a long freaking way to go. This time he's telling us, look, we're getting there, but things could break. And that's really important, this idea that things could break. In fact, he specifically emphasized the word could multiple times, actually. So that was sort of his way of conditioning, I think, markets to say, look, we have no idea. When he emphasized could a couple of times. Take a look at where those are, and I'll show you where he says we have no idea. We expect this labor market rebalancing to continue. Evidence that this tightness in the labor market is no longer easing could call for a monetary response. We don't have that evidence that it's not easing, but it could happen. So that could was a really important one. Here was another one. Additional evidence of persistently above trend growth could put further progress on inflation risk and could warrant further tightening, but not necessarily. Look at the double conditional here. He's basically saying, look, just because we have above trend growth only matters if it affects inflation. Actually, if you go back to the bingo card, on the bingo card, I think we actually had exactly that. Let me see where that was. There. It's that one. Oh, hold on. It's black. That one. The bottom left corner. Demand above trend may be acceptable as long as inflation doesn't unanchor, right? So I'm actually going to put a check in that. He didn't exactly say that, but that double condition, in my opinion, is exactly what he meant. So as a Fed watcher, that's a check mark for me. I'm going to go back to the sheet now. Let's keep looking at what he said with could. So that double conditional right there, that's saying we might be okay with above trend growth. Look, if the economy's booming and inflation's down, we're not here to say that can't happen. Equivalent rents. Okay, well, that talks about, that wasn't an important could. That's why I didn't highlight it. Okay, talked about that. That's the labor market rebalancing. Okay, here, doing too little could allow inflation to become entrenched, right? This entrenching, this has to do with expectations, and ultimately, could require monetary policy to be higher, basically. Okay, fine. So a lot of conditionals here, right? But notice this is a very different tone. This isn't a J Powell that's telling us we will go higher. He's saying, look, if crap comes in bad, we could do more. In fact, we did just get the University of Michigan sentiment data. We got sentiment that actually declined a little bit to 69.5. The expectation was 71.2. 1-year inflation expectations actually ticked up a bit, 3.3 to 3.5, not great. And the 5 to 10 year ticked up a tiny bit from 2.9 to 3.0, both on expectations and what we were before. The 10-year treasury hasn't basically moved at all. It's basically flat. Markets are still, they're still positive, which is nice, but a little uncertain because people are trying to digest this Fed talk here. And this was not victory. We did not expect a victory speech. We expected this sort of conditional optimism, and that's what we got. Now, I want to show you this one line that he says because it's pretty remarkable. So buckle up for this one line that he says. Quick shout out, though, obviously, if you want to support the channel, you want to invest in House Hack, make sure you're a course member. Sign up for the courses linked down below. Last time we raised money, 80%, think about this, of the $27 million House Hack raised, over 80% of the investors were course members. So consider that for a moment. And that's accredited investors. So we are expecting to basically just have the offering be for course members only. So if you want to be in it, check it out. Check out the courses linked down below. But okay, listen to this line right here that we got from J Powell. You ready for this? Conclusion. I loved this line. Okay, this was hilarious. As is often the case, we are navigating by the stars under cloudy skies. Okay, that's impossible. You can't navigate by the stars when you can't see the stars. He's literally saying, look, I was on the schedule to give this speech. I have absolutely no idea what the HE double hockey sticks is going to happen. Things right now seem like they're okay, but there are some risks. I thought this was interesting. It actually started bearish. He started bearish, and I wrote WTF on it when he said this because there was this one part that was bearish. Remember, my goal is not to just feed you one narrative. I always want to give you the good and the bad. I really try my best with that, whether it's politics or whatever. Look at this right here. I literally wrote, what the F? So he's like, hey, on a 12-month basis, core PCE inflation peaked and has gradually declined, basically all the way through July. And then he says, lower core inflation readings in June and July were welcome, but that's only 2 months of good data. And I'm like, bro, what are you smoking? It's been like a year of good data. So I thought this was a way of him kind of like trying to inject that balance, right? I kind of think he had to put some bad in with some good so that it's not all good, because he's trying to signal, hey, it could go either way, and we have no idea. That's basically what he said here. But again, this is a world of a difference from last year. Remember what we heard last year. Last year, we literally heard him say, the historical record warns against premature loosening. He did not say that. We have to force demand and supply into balance. Didn't say that this time. He actually said, hey, if demand essentially is continuing to go up, we could raise rates if inflation unanchors. In other words, if inflation doesn't unanchor, it could be okay that demand goes up. That's impressive. The labor market is clearly strong, devolved. It devolved into, well, the labor market is definitely coming into more balance, but there's still some work to do. And that could change, but it's trending in the right direction. Last year, he said we need to be restrictive for some time. This year, he's like, we've been restrictive for some time. Well-anchored inflation expectations. Of course, that's almost a default check mark. No Volcker mentions this time. And he didn't, there was one thing he mentioned last year, which was rational inattention. So last year, the talk, rational, oopsies. I'm trying to, those are my notes. Hold on. What did I do wrong here? That button. Okay, there we go. Okay. What was I going to say? Okay. Rational inattention is basically inflation is if inflation is stable, people don't care about inflation. Like businesses and people don't plan for inflation when inflation is stable. So they're not really worried about it. When inflation is unstable, that's when people are freaked out by inflation. And then they start pricing in more inflation and they're worried about more inflation. So a bottom line out of all of this, to me, bottom line out of the whole kit and caboodle here is this was a cautious Fed. He does not want to create a stock market rally, but he's not trying to create a stock market crash. Last year, he's like, bend over. So this is nowhere close to victory. It is a neutral Powell. And I want to see how the rate market is pricing in expectations. We were like at a 10% chance of a hike in the next one. And let's see where we sit now. So we are sitting at a 20% chance of a hike, but that's been stable for basically this week. Last week, we were at 10%. If we look at the 5-year forward break even, it's again trending down. It's sitting at 2.35. The 5-year break even is sitting at 2.26. And yeah, that's looking good. So I'd call it stable. And as far as what Wall Street is saying, the upcoming meetings, we're in a position to proceed carefully. This is just basically a way of saying, hey, like we might end up pausing. We're not going to look for R star. We really have no idea where that is. So we're going to look for the incoming data. No fireworks at Jackson Hole expected by the options market. And that's what we got. No fireworks. We got a neutral Fed. Fed didn't splash any cold water or hot water on anyone. Very neutral. Just reading what the suits are thinking. Yeah, I mean, roughly the same thing that we summarized here. So I would say this is kind of a no news is good news approach. I'm satisfied with this. No news is good news is a way of saying, hey, we didn't get reamed by him today. So this is where you kind of go, oh, okay, dodged a potential bullet. That's it. All right. Thank you so much for being here. Check out those courses on building your wealth linked down below. Oh, wait. Is there a new Nick T piece? Hold on. There's a Nick T. Let's see what Nick T has to say really quick. I imagine it's going to be relatively similar, but let's see what he has. Jay Powell's word of the day, carefully. It was a risk management speech. Okay, well, that's the same thing that I said. Are you watching my video? Okay, it's not the same thing I said. I know. As expected, Powell rejects the idea that inflation target would change. Well, duh. That's nonsense. It doesn't matter. Risk management speech. Fed chair notes economy hasn't cooled as expected. That's demand coming down, right? And says signs of strength could warrant more action. Right. Could, not will. Very important. Nick T literally put the word could in the byline of his article because we agree. That was very, very important. Let's see here. Yeah, Nick T also picked up on the 2 months of good data are only the beginning. I thought that was weird. That was the what the F that I wrote down, right? So we picked up on the same thing. Powell echoed some of the themes in a more nuanced speech on Friday, explicitly rejected the idea about changing 2%. That's not a big deal. We don't know what the neutral rate is. That's not a big deal. Powell's speech illustrated how he's trying to thread the needle between slowing hiring, investment, and spending to bring inflation down without providing so much restraint that it would needlessly, severely damage the economy. Yep. Good call, whoever said that in the video or in the chat here. So I appreciate you. Okay, awesome. Again, cautious optimism. That's what I call it. All right, folks, appreciate you being here. Thank you so much. This is the first time I've done a Fed meeting on TikTok, Twitter video, Twitter Spaces, Twitch, and YouTube. All right, folks, we'll see you. Goodbye.